Hey, how's it going, everybody? This is Jason Eichmiller, and today we're going to discuss how seniors can self-fund their long-term care insurance plan, i.e., not have to rely on an insurance company to do it. So we'll jump right into this discussion. So what's the deal with this? How do seniors self-fund their long-term care? So let's get a little background. First, we're going to talk about how to self-fund your future long-term care without sticking a whole bunch of money into some insurance policy or sticking into a bank or tying it up. So without spending more than a couple $100. Um, Staying liquid, meaning that you don't drop any money anywhere. And this really works for seniors. So for it to work well, you've got to be 62 or older. You've got to own your home. You've got to live there, and you've got to have a lot of equity in it. But if you are a senior, you're 62 or over, and you own your house, and you live there, and you have a lot of equity, then let's hang out. Won't take too long, but I want to share this information with you. So, what is long-term care insurance? In a nutshell, long-term care insurance is insurance for seniors 65 and older, and it provides a couple types of care, basically nursing home care, home health care, adult daycare, and it's normally you pay the insurance company X amount of money. They write out and say we'll pay in case you become disabled chronically, we have a mental condition, and we approve it, then we'll pay out and we'll reimburse whoever's giving you the care. So we'll reimburse for X amount of dollar for X amount of time. So that, in a nutshell, is what long-term care insurance is. Why do we need long-term care insurance? So there's a crazy statistic out there that scares the bejesus out of me, but 68% of adults over 65 are going to need it at some point in time. Whether they need daycare, whether they need nursing home or home health care, they're going to need something. So it's almost 70%. And as we get older, that number is just going to creep up. But this care is not cheap. It's really expensive. Common cases are normally between 60 and 80, $90,000 a year, but long-term care, especially if you need skilled care, can well exceed $100,000 a year, which is pretty crazy. Healthy people are living longer, so if you don't have any if you don't have any health conditions, then you're probably going to live in your 80s and 90s and maybe even to the century mark, which means that at one point in time down the line, you're probably more likely to need the care. And these costs are ridiculous. We talked about the costs before, but assuming that you don't have a money tree, if you do have a money tree, you don't really care about it. But if you don't have a money tree, like most of us, um, a long-term care event can absolutely cripple a family. It can cripple the heirs, it can cripple inheritance, but it can also obviously make things real tough for the senior who needs the care. So why does long-term care insurance stink? Number one, it's expensive. Number two, the premiums can increase. There's very few policies out there where the premiums are actually locked in. Three, the care can be refused. So if you don't meet all the terms in the contract, then they can refuse your care. And what do you know if you're 62 when you get this long-term care policy? What do you know what your condition is going to be when you're 85 and you actually need the money? But they can actually say, no, you know what, you don't qualify. We're still going to take your money, but we're not going to give you the care. We're not going to pay for the care. There's limits on how much um, the carrier will pay per day, per month, per whatever, and there's limits on how long the care lasts. Normally it's between about 2 and 5 years. If you're not in good health, then it's very hard to qualify for these plans. And if you do qualify, they're going to bang you over the head with their costs. So going back to the first point, it gets pretty expensive. And also, I guess finally, as you get older, let's say you're between 65 and 70, and you just think about it and say, hey, I'm pretty healthy. I need long-term care insurance. They're still going to bang you over the head. It's still going to be very expensive. So, what alternatives are there? There's two types of alternatives. One is reactive and the other is proactive. We'll talk about the reactive alternatives first because honestly, that's what happens most of the time. The first reactive alternative is to die and die quickly and die before you actually need the care. Number two is you've got some branches left on the money tree, so you pluck it dry. So you're paying out of your pocket, your family's pocket. Three, if you know you're going to go into a nursing home, don't want to be in the home anymore, or you don't think you can make it, you sell your home. Four, Medicare normally pays for about 100 days, but God forbid you have 105 days or this is an ongoing thing for the rest of your life. What do? And number, what's that? Five is Medicaid. So if you're broke, you probably will qualify for Medicaid. It might make you jump through hoops, but you'll qualify. Or if you're okay with going to the state-run Medicaid nursing home, then Medicaid will take care of you. Most people that I know and I work with are not okay with going to the state-run Medicaid home. Proactive alternatives. What can you do proactively? You can get an annuity life insurance hybrid. Some of these come out. They do a decent job of giving you living benefits. You still have to qualify. You have to be disabled X amount for them to kick in. And they tie up your money. But if you have some money, you can do that. Number two, save your pennies. You can contribute to your savings. Make sure that that money tree is there so that when you pluck it, there's something to be plucked, although that's kind of tough these days. And number three, you can get a reverse mortgage line of credit. And that is actually what we're going to focus on. We're going to talk about this because it's a really neat program where you don't have to invest any money. You're all liquid. You can use your house to pay for the care, and it's got some pretty cool features. So let's move on. Why the reverse mortgage line of credit? Slide should actually be, what is a reverse mortgage line of credit? It's similar to a home equity line of credit. That's what HELOC stands for. However, you get some money, you get access to some money, and you don't have to make any monthly payments. When you don't take any money, no interest accrues on the money that's sitting in the credit line. So you have $100,000 sitting in the line of credit, you don't make payments on it, and in fact, until you use it, it's just sitting there. Nobody's charging nothing on it. It doesn't become due at a set time, which normally means a balloon date or a reset date. It's just due when both of you, husband and wife, permanently leave the home. If one leaves the home, one dies, then the other is fine. It does not become due. Here's where it gets interesting. So the line of, we'll skip over the fourth one. The line of credit actually grows when you don't take it. It gets bigger and bigger and bigger. Tax-free. Take your money tax-free, and no taxes are charged on the growth of that money, which is really cool. Backing up a little bit, what are some basics about reverse mortgages? You got to be 62. This is a program for folks who are 62 who own their home and live there. It gives you part of the home's value, not the whole thing, but part of it, based on your age, in tax-free cash. Now, you can take the money one of a few different ways. We're going to focus on the line of credit, but you can also get it in monthly income, kind of like an annuity, or you can get it in upfront, or kind of get it in, combine it, just tweak the program to work as well as it can for you. But again, we're going to talk about using this as a line of credit for long-term care, so we're going to mainly focus on the line. When you die, the house goes to your kids, they get it, and then they just refinance it to pay it back or sell it to pay it back. So that is the basics of what a reverse mortgage is. I've got lots of other videos that talk about reverse mortgages, and you can always call me too, and I'd be glad to discuss it with you. But that's kind of the bones here. Now, bad stuff about reverse mortgages. There are so many myths out there about reverse mortgages, and fortunately, they are not true. So number one, the house goes to the kids. Well, if you want it to go to them, it'll go to your heirs. They'll get the house and they'll decide what to do with it. And they will get, let's say 100,000 is owed on it and the house is worth 200. They sell it for 200, 100 gets paid back. They actually get that extra 100 in their pocket. The spouse cannot lose the home. So if you have a husband and wife, husband dies, wife is still fine. Just stay on title, keep paying the property taxes and homeowners insurance, and she's good. Most kids actually, once they understand what a reverse mortgage is, And especially if they know that it'll keep their parents in the home, they want them to go out and get it, which is pretty neat. And finally, the fees. People think they have high fees, but that's not true. All the fees are regulated by HUD and the FHA. So again, reverse mortgage line of credit is just a line of credit that has no monthly payments. The money's not due at any time. If you don't take it, it's not, no interest is charged. The credit line gets bigger over time, which is really neat, and no taxes are charged on the growth of funds. So we'll spend a second on here, on this sucker right here. This is a line of credit, and if we, let's go back. So if we take a look at a house value, a 62-year-old who is getting a reverse mortgage line for just basically for their in-home care future needs. They're free and clear. They don't have a mortgage. They have a $300,000 house. Then they're going to get a line of credit of about $147,000. See right over here where the thing is blinking. Their line of credit, which is right here, grows over the year. So it goes to 156, 166, 177, etc. So in 5 years, it's 201. In 10 years, it's 275. In 20 years, when they are 81, soon to be 82, it's $514,000. So you can see how the line of credit grows. And when you take that money, it is tax-free, so you don't have to pay any sort of taxes on it. So now hopefully you can start to see how it would be neat for a long-term care plan, whereas you're not touching this money, you didn't invest anything into it, and down the line if you need it, it's a lot bigger and you don't pay taxes on it, which is exactly what you want a long-term care policy to do. So let's talk about Dave and Jeanette real quick. They're 62 and live in their home, no mortgage, free and clear. It's worth $300,000 and they have $200,000 in investments and annuities, but they're really concerned. They're worried about their long-term care costs. Dave he's not really sick, but he has some cardiac stuff. So they really can't afford the policy. They can't afford a long-term care policy anyway. They can't get a life insurance policy that'll give them enough if they need it. So what they do is they get a reverse mortgage line of credit. They don't take anything out of it. They don't put anything into it. They just get it, set it and forget it, if you will. At age 73, that line of credit is $311,000. At 83, it's $580,000. So again, we can see how it builds up. So the cash is tax-free if they need it, and the home still goes to the heirs when they pass away. If they didn't take anything, nothing is owed. But if they need it for the in-home care, then they can get it, and it doesn't have to be for a set thing. They can spend the money the way they need to spend it. So hopefully that makes sense. We're on 13 minutes, which is longer than I expected to talk. So hopefully you enjoyed this. Hopefully you learned something. And if you need anything, just reach out to me. My phone number is 267-289-1095. And my email address is Jason Eichmiller. Yes, it's a long last name, at openmtg.com. I really appreciate your time. Again, hopefully this is you've learned something, and anything you need, just feel free to reach out. Thanks a million.